Good afternoon and welcome to me, Paul Merrison, as we do LSBF TV. Yay! So we are here for some business tax. This is, where are we at now? We're at week 3 out of 10. You may remember me from week number 1. And I am today going to be looking at some business tax stuff relating to task number 3 on the assessment. As always, our aim over the 10 weeks is to get through a whole assessment, and if you want to ask any questions, unlike week 1 where we had a little technical issue, I can see comments coming up to my left. So without further ado, let us begin. So for week 3, we are going to be working on task number 3, as I said. And task number 3 is about capital allowances. Now, the nice thing about capital allowances is we are dealing with a relatively standard calculation layout of what we have to do. So if you put the practice and the effort in and just follow the methodology, it should all be fine. In addition to having done the practice, we do have that rather helpful thing that in your reference material there is a lot of help as to how capital allowances work. So if you forget a little something here, a little something there, don't get too worried. Even better with capital allowances, it's in 2 separate sections in the reference material. A lot of it is right at the very front, so in the first bit. So just a reminder that when you do your assessment, down the right hand side of the screen on the AAT assessment site, in blue will be various tabs that you can click on to go and check out allowances, rates, rules, thresholds, and stuff like that. As I said in week 1, but I repeat here, it is absolutely essential that you have practiced the practice assessments on the AAT site, but also you've gone and practiced an assessment, ignored the questions totally, and used the opportunity to click through the various headings in that reference material so that you know it as well as you possibly can before you sit the assessment for real. That way you'll be able to find things more quickly, and you might even know what is in there and what is not worth looking for because it isn't. Okay, so let us get up and running then. With capital allowances, what can go wrong apart from a lack of practice? What can go wrong? If you look at what the examiner says and the marking feedback on this one, the 2 biggest problems seem to be not understanding what to do when you've got an asset which is private use, so it's partly being used in the business and partly not. And we've got that coming up in today's task. And also what to do when the accounting period is not 12 months. And again, we've got that coming up in today's task as well. Okay, so without further ado, capital allowances. What's going on here? Well, as you may be aware, in financial statements or financial accounts, how does the cost of assets get spread to match against your profits? It's via a process called depreciation. Slight problem is that the directors get to choose their depreciation policies, which means if that depreciation were to be an allowable expense for tax, the directors would have too much control over it and might depreciate their assets quicker than they should do, perhaps, to try and get their tax bill low as soon as possible. HMRC does not accept that as a way forward, and so says you can do what you like in your accounts, mate. We're going to have our own depreciation tactics, and we're going to call them capital allowances. In addition to stopping directors manipulating their depreciation rates for tax purposes, another benefit of this is that the government, if it wanted to encourage the purchase of certain types of asset, or even just encourage the purchase of assets in general, can have special rules for capital allowances where it gives a nice big deduction in year one, possibly for the entire cost of the asset. So you buy an asset and all of it would be a deductible expense for tax purposes up front. And if you can buy an asset and immediately get the tax saving back on it, maybe that's enough to encourage you to invest. Okay, enough about the nice chit-chat to get us going. It is time for us to have a go at something. So this is a task number 3, and if we just have a little slide down here, scroll it down, you can see we've got some information, and we'll come back to that shortly. We've got a little question to start us off, which we'll do in a minute. And then we've got a nice big capital allowances thing to do. Lots of empty boxes. The boxes on the left, these wider ones here, we're going to be writing words in. And then it's up to us to label up all of the columns in whatever way we see fit. And then put all the relevant numbers in here and do some calculations. So that is the plan. So let's get on with it then. Now I always find the best tactic when you're doing assessment questions is go and read the requirement first, understand what sort of thing it is about, and then go and read the information as necessary. So this first requirement, A, says calculate the maximum annual investment allowance that Arthur can claim for the period ended 31st of March 2017. Now, one interesting word that I note in there is the word period, which suggests this is not going to be a 12-month year, otherwise it probably would have said year. I'm also intrigued by the word calculate. So this is not going to be going and stating an allowance out of a book. I suspect we're going to do something with it. So what is the annual investment allowance? What is that all about? Well, this is the government saying to businesses, the first however much that you spend on assets each year, you can write it off in full for tax purposes and get, therefore, a tax deduction on the whole amount of it, as an incentive for people to invest. And from the 1st of January 2016, how many assets in terms of pound sterling can you get as a full 100% deduction? The answer is £200,000 for a 12-month period. Which is nice, obviously. Nice big tax deduction. What does this mean? It means if you buy more than 200,000 of assets, anything above 200,000 would be subject to the normal writing down allowances that we'll be doing in the bigger part of this question coming up. Now, the good news, I suppose, is that 200,000 figure there is in the reference material that I was mentioning a few minutes ago. So you've got that number. You can just go and look it up. But be careful. That is for a 12-month period. What is this company? Sole trader. We don't know yet because we've not read it. So back up to the top. And it tells us that Arthur runs a painting and decorating business as a sole trader. He has the following fixed asset information for the 15-month period ended the 31st of March. Aha! So it's 15 months. And that means you need to take your 200k, multiply it by 15 over 12 to gross it up, prorate it up, whatever you want to call it. And that means the maximum he could claim in AIA is going to be 250 grand. So there is your answer. Whether he is actually going to claim the 250 will depend on what he has bought. Because number one, he will need to have spent 250 grand. And number two, he will need to have spent 250 grand on acceptable assets, because not all assets count towards this. The one that is maybe the most well known being cars. So we're going to have to take a look when we do the capital allowances that are coming up in Part B. So Part B, calculate the capital allowances that Arthur can claim for the period ended 31st of March 2017. Right, so here we go then. Leave that box empty. Leave that one well alone. In fact, there's every likelihood that when you do the assessment on screen for AAT, you won't be able to type anything in that box anyway. And in here we write written down value brought forward. And then we need some columns. Now, I like to have first year assets, your annual one as well, your AIA from Part A of the question. We're going to need a general pool. And it turns out in this particular question, we are also going to need a single asset pool. Pool sounds a bit odd when there's only one thing in it, because there is going to be an asset that exists at the start of this exercise which has some personal use. So we can't have that in with other assets because the personal use needs to be taken into account. And that is going to be Arthur's old car. And then in the final column, we need to show all of the allowances that will go into the tax comp and reduce our taxable profits. Okay then, away we go. So what have we got in the question? It tells us that the general pool has a brought forward balance of 58,995. So down we go here, 58,995, in it goes. And then up we go here, and we are told that Arthur's car brought forward is 18,850, and it is 25% private use. So Arthur's car. Now I've said his old car because I happen to already have noted that that car is going to get sold during the year, so it's going to be disappearing. And because it's going to be disappearing, the fact that its CO2 emissions are 110 grams per kilometre is not really going to be of any interest to me, because I'm not going to be doing a writing down allowance on that car because it's the year of disposal. Okay, those are our brought forwards. We then have some additions. And during the year, it tells me that Arthur seems to have purchased another car. And this one is 15% private use, has CO2 emissions of 75 grams a kilo, not a kilo, a kilometre, and costs 29,750. So down we go here. That is a first year asset. It doesn't qualify for AIA because it's a car. So I put a little heading in there, additions. Arthur's got a new car, and that's $29,750. So far, so good. Back up we go. And also during the year, we have got some vans. 10 of those. 236,050. And vans do count for AIA, so they will go in that column there. Right, so we've done our additions. Let's now have some disposals and a little bit of a change of colour because I'm in a green mood for some reason. Disposals. What did the question tell us about those? Arthur's old car, which was 25% private use, remember, has been sold for $12,850. So back to black. Arthur's old car, off it goes for $12,850. That's a disposal, so it's going to be negative. Isn't this fun? Is there a better way to spend a Friday than doing capital allowances with free guidance from me? No, there is not. Tell you what, if I had a glass of wine in my hand, a nice Chardonnay, this would be perfection. It's very close though. Also disposed of during the year are 10 vans, which explains why they bought 10 new vans, and they went for $34,000. Now those vans must be in the general pool because they're brought forward, and that's the only other thing that's there. So off go the old vans. 34,000 in there. And we have put in all the brought forwards, we've put in the additions, we've put in the disposals. So now what we're going to do is some totals is the word I'm looking for so far. So I'm just going to put these lines in to make it a bit clearer for you looking at it. No need to put the lines in on your actual assessment. So what have we got? We've got 29,750, 236,050, and we've got 24,995 and 6,000. Right, having done all of that, it is now time to do our actual allowances. I think I've spelled correctly. Yes, I have. 4 separate columns. We've got a brand new car to deal with, which has some private personal use. We have got the new vans, but they are subject to AIA. We've got the general pool, and we've got his old car, which has been sold, which means that 6,000 is going to have to disappear because that car doesn't exist anymore. Let's take it one step at a time. There is a first year allowance on the car. And because that car was 75 grams per kilometre, which is a low emission car, that is going to get a 100% allowance in the first year. Now the grams per kilometre rules are all in the reference material, so you could go and look it up if you can't remember the significance of 75 grams. So all of the benefit you're going to get is in year 1. Now, of course, the reason why that rule is there is the government wants to incentivise environmentally friendly or environmentally less unfriendly vehicles. And this is one way to incentivise businesses to go for those, giving them a bit of a tax break. Okay, fabulous, 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 fabulous. Next, now we've got that column out of the way, we move on to the annual investment allowance. And remember, Arthur can have up to 250,000 because this is a 15-month period, and therefore, since 236,050 is less than 250, he can have the whole lot. So isn't this working out well for the lucky so-and-so? The vans are going to be total write-offs for tax purposes as well. Next, I'm going to do the final column, just because it's nice and easy. That asset has now gone. So just as in financial accounts, you get a gain or loss on disposal, you get the same sort of thing with capital allowances as well. Basic logic here. Because there's 6,000 still left, in effect it means that he hasn't had the deduction against tax for that 6,000, and now the asset's gone, he's going to get it. Sort of. So that balancing allowance is 6,000, and that means that for the 3 columns we've done so far, not going to need much more space, so I'll put my carry forward in now. His old car has gone, so that's 0, and he's had everything he's going to get for the new car and for the vans. Which leaves us with the general pool. And for the general pool, he's going to get, writing down allowances, at 18%, but it's a 15-month period. So what does that mean? Maybe we should do this as a little calculation down here underneath, just so we've got a bit of space to consider it. So we had 24,995 as the total. And we're going to multiply that by 18%. And I'll just get my little calculator out here so we can do this. And we have got 24,995 times 0.18 equals, and that would come out as 4,499 and 10 pence. But we then have to multiply that by 15 over 12 to get to 5,623 and 88 pence. And we're going to deal in whole pounds, so that's 5,624. So back up we go. Whoops, a bit further so we can actually see it. That would help, wouldn't it? So that goes in there, meaning the general pool will now come down to 19,371, if my mental arithmetic is correct, which it is. Right, fantastic, but not quite the end of the story, because we must remember that in here we have got private use on the new car and we have private use on the old car. So what happens then? Well, let's take the allowances over into the final column just so we've got them all there. And let's do it in green actually. The 236,050, that's fine, no problem with that. And the 5,624, no problem with that. But the other two have got private use. The old car, let's just go and remind ourselves up here, whoops, was 25% private use. The new car is 15%. So what we do is we take the old car of 6,000, that one there, so old car, you take your 6,000 allowance, multiply it by 75% because of 25% private use, and that gets you to 4,500. Same thing with the other one, but multiplying it by 85%, and that gives you 25,288 and 4,500, and a total of 271,462, and we are done. Okay, so there you have it. That is capital allowances. Obviously there is a bit of a template going on there and it needs some practice. Most of the rules are in the reference material that you have access to while you are doing your assessment, so please don't forget that. Make the most of the stuff that you've got to help you. That is the end of Business Tax show number 3. Thank you very much for watching. I hope you found that useful. We hope to see you again for next week, and if you're doing personal tax, that's coming up in about 3 minutes' time. The very best of luck with your studies. It's been a pleasure. See you very soon.